Good morning or good afternoon, teacher and students. We are the group number 2, and we are going to talk about the topic of securitization. And well, let's begin with this conference.
Hi, my name is Luis Torres, and I will do the introduction to this topic, the securitization. First, we will answer that question, what is securitization? Beginning with the definition. A short definition is that a set of securitization is an structured process whereby the interests of a financing are pooled and brighter and sold in front of backed securities. Even a shorter definition, it's a tool for financing. It's a process because you have to follow steps and comply with rules. It is structured because you have to use it to have to reach an agreement, and there has to be a lot of regulation involved. And taking different perspectives, such as the intermediary, the one who gives the credit to companies. This process allows them to transfer property risk to entities with the ability to manage them. And by eliminating assets and supporting their balance sheets with it, companies have some ability to save on the cost of external financing. Also, to give a brief history of this process, I put some events on the history where securitization have a big participation. And to begin, the concept was founded in 1970s or the 70s, when in the United States, the Department of Housing and Urban Development generate the first transaction using an asset backed by a mortgage. And in the 80s, by 1985, securitization techniques had already been developed and were used for the first time in non-mortgage assets, like vehicles, financing. With the passing of the time, a strong potential was seen in this technique, leading more and more entities to seek financing in the securitization of their assets. As I put as important event, the first significant bank credit card sale came to the market in 1986 with a private placement of 50 million of outstanding bank card loans. Okay. And the 90s, securitization technology was applied to a number of sectors of reinsurance and insurance markets, including life and catastrophe. The 1997, the first public securitization of Community Reinvestment Act, or CRI, loans started in 1997. Okay. At the end of 2004, the largest sector of this market were credit card-backed securities, common equity backed securities, automobile-backed securities, and collateralized debt obligations. Okay. Maybe the most important event that we see here is the 2008 securitization is often associated with the financial crisis of 2008. Well, it contributed to some extent, was the fuel that spread the fire around the world. And because of a direct effect, it explained that emissions in Europe and the United States were lower and lower every year. They have not returned to the pre-crisis levels. But as we are today in the context of the current cautious and low growth credit environment, a simple securitization reform can provide banks with the funds needed to provide new loans to the real economy. And that's why it's being proposed by several stakeholders in the recent years. To understand how it works, we have to know that there are two types of securitization process: the installment loans and the revolving asset transactions. I think the definition that we put on the right of the presentation, it's okay, but the graphic that we found to explain this process, it's even better. It's perfect to understand. We have what is the process. A short definition refers to the process of converting debt into securities, which are then bought and sold in financial markets, and we have them the process. Banks or international institutes will collect money into a pool, the division of pool into small parts and selling them as securities. Then buyers of these securities get interest mortgage into payments, and these securities are called mortgage-backed securities. And this is a process because they can do it again and again, and that's why it's associated with the crisis of 2008. They obviously, as a process, they have some limitation and some benefits. As we see in the usefulness, boost liquidity because it's a financial tool and helps raising funds, and portfolio diversification and quality returns. And in the other hand, we have the limitations, risky for lenders and difficult to assess the risk factor into securities. And this securitization and assets, at this part, I will explain a bit of these two types of securitization, the installment contract basic securities and the revolving asset section. As I put some examples in the installment contract asset-backed securities, home equity loans, auto loans, credit card receivables, student loans, stranded cost utilities. And in the revolving asset transaction, I put two types, the secured and the insecure. Okay. In the installment contract asset-backed securities, these have a strong structural similarity to mortgage transfer securities, giving investors an undivided interest in a specific group of assets owned by trust. The trust is established by the pooling installment loan contracts on automobiles, boats, or other assets purchased from a loan originator, often a bank. Investors receive monthly interest of outstanding balance of their certificates, including interest for a full month of advancement payment. The amount of principal included in each payment depends on the prepayment and amortization of the underlying collateral. And in the other hand, a static portfolio of credit card receivables typically has a useful life of 5 or 10 months because that life is too short for efficient issuance. Revolving loan-backed securities are structured to facilitate cash flow management. Rather than distributing principal and interest to investors as received, securities distribute cash flow in stages, a revolving phase followed by an amortization phase. During a rolling period, all interest is paid, and the principal payment are reinvested in additional accounts receivable. As for example, customers use their credit cards or make an additional draft on their home equity lines. At the end of the revolving period, an amortization phase begins, and principal payments are made into investors along with interest payments. Basically, it's as a first is a cycle to preserve the liquidity and to avoid the losses of a short life of these assets. That's all. Thank you.
Good afternoon, teacher. I'm Jessica Rossi Saldaña, and I'm going to talk about private corporations and securitization. In this topic, we are going to see how can private corporation use securitization, the investor role in securitization, role of rating agency, and last, investor's view of securitization with rating agencies. First, we will know how can a private or public corporation use the securitization process. Well, the securitization is the process in which the liquid assets transform into a security that has the characteristic of being tradable. The company that wants to get rid of assets, it's called originator. It is in charge of putting a group of assets together to sell them to investors. This group of assets is mostly known as reference portfolio. Whenever a private corporation wants liquidity or wants to get rid of illiquid assets, securitization is a normal way in which that company can do it. Often, an asset is worth more out of the balance sheet than when they were in on it. The originator has to ensure that this group of assets follow the following characteristics. They must be homogeneous so that analysis that the investors make in order to buy assets becomes easier. These pools of assets have to have enough assets to attract investors' attention. They must have enough diversification to reduce vulnerability of the assets. And last, they must be tradable and have a good credit quality. So what is the investor's role in the securitization process? Well, securitizations allow the investors to buy assets that usually are not available for them. Investors assume the creditor's role that have many disadvantages, like the credit risk when the debtor cannot pay back the debt, and the investors end up assuming the losses. Lack of transparency, like in the 2008 crisis, when the originators do not share important information to the investors. And last, investors sometimes end up paying for a group of assets that has no real value, so they do not receive any return from them. But also they have some advantages as well. This process converts an illiquid asset into a liquid one that has the characteristic of being tradable. Investors receive sustainable incomes from this security. And last, rating agencies help the investors to invest more efficiently. So what is the role of rating agencies? Well, rating companies have a crucial role when it comes to grading whenever an originator company wants to issue a security. This grade will help the investor to have a better understanding of what he's buying. The grade will show how risky a security is. Then the investor must decide if he wants that pool of assets or not. The most known rating agencies are S&P, Moody's, and Fitch. There are some cases in which these rating agencies fail to understand how a security is risky to the investor. Rating agencies have to take into account the credit risk, the liquidity risk, the squad counterparty risk, the guarantor risk, the legal risk, the sovereign risk, the interest rate, and the currency risk, and prepayment risks in order to give a rate to a company. So how can we associate the investors and the rating agencies? Well, investors seek for gains, so they often use some tools in order to invest. Often they use statistical analysis. They have to take into account the financial profitability, the return rate, and the historic analysis of the company. These tools help them to know in which security, asset, or financial good they can invest. The role of the rating agencies is to make sure that the investor is investing in a good asset. Also, we have to talk about the risk that sometimes the investor that invested in a security has to incur whenever he's investing in that. A rating company has to ensure that the investor ends up having higher returns.
Now let's talk about the risk of securitization, and one of them, and the first, the most important, is desecuritization. And what does it mean? It refers to the reverse process of securitization. According to some studies, it brings issues back to normal politics, enabling political discussions and negotiations, and also bringing back democratic procedure. by this way surprising, even though they are two sides of the same coin. Comparing securitization and desecuritization is a large. Securitization is to make sure something, and in this way, desecuritization is a largely underutilized and open to interpretation concept. In a study about security, a new framework for analysis was hardly analyzed about the topic of desecuritization in the majority of the book. And only in that chapter, the authors briefly discuss the relation between desecuritization and liberal economy. What does it mean? Desecuritization also affects the economy and the politics in the world. According to a study of Busan and Weber and De White, desecuritization is a part of the liberal project to foster economic relations between states. It allows states, private sectors, and their people relatively more space to pursue economy, cooperation, and development, creating the potential win-win scenario for both sides without worrying too much about relative gain. The normative superiority of securitization over desecuritization is evident in the fact that there is a securitization theory, but instead there is no desecuritization theory. In literature, desecuritization does not receive the same treatment as securitization, nor is it paid the same attention from an analytical point of view, and the majority of authors barely mentions it, and those who do describe it as a conceptual twin, while others consider it an opposite or an inverse mechanism. Hansen argues that one would be meaningless without the other. It means that if there is no securitization, we won't have desecuritization, because to have the securitization, we need a sure system, something sure that could be desecuritized. While the successful securitization of some issues has advantages, such as the chance to buy time by going on the fast track of emergency policy, Busan considered that desecuritization is the optimal long-term option, since security and securitization constitute a failure of the ordinary political avenues, in which there is more freedom to enter into debate and engage in open dialogue. In terms of security, for on the contrary, immediacy and the search for short-term remedies prevail, in the opinion of Weber, that says that security is the opposite of politics. A view of security as a failure of conventional politics continues to be present in later works, in which the author development negatively implicit the dichotomy of security and politics. And for his part, for his opinion, he thinks that neither securitization or desecuritization are in themselves positive or negative. He says like securitization is the weak part of the coin, and desecuritization is like the wrong, what is the fail, and that. Now, also the security should explore not only how, but also why actors securitize, as the intentions may be indicative of the potential outcome of a move securitizer, drawing inspiration from consequentialism, and in that way to not have incorrect theories about these ultimate consequences. And now, let's talk about the implications for a monetary and banking policy. As I said a few minutes ago, securitization is to put something sure. In this case, to put a system. Which system we are going to put sure? In this case, for example, is the transference of a bank that needs to be really sure, because if not, there are some hackers or people that want to steal the money or the value of the transaction. And well, for example, a very good example to the implication that has the securitization and a monetary and banking policy can be the topic of the cryptos. The cryptos like the Bitcoin, Ethereum, and those virtual money are a sure system, because you don't know, you can't identify where is the money from, and you neither know where it goes designated. So securitization is a financial innovation that experiences a boom-bust cycle. As many other innovations before, this paper analyzed possible reasons for the breakdown of primary and secondary securitization markets, and argues that misaligned incentives along the value chain are the primary cause of the problems. The illiquidity of asset and interbank markets, in this view, is a market failure derived from ill-designed mechanisms of coordinating financial intermediaries and investors. This liquidity is closely related to the design of the financial chain. Our policy conclusions emphasize the crisis prevention rather than crisis management, and the objective is to restore a comprehensive incentive alignment. The toehold for a strengthening regulation is surprisingly small. First, we emphasize the importance of equity piece retention for the long-term quality of the underlying asset pool. And as a consequence of this, equity piece allocation needs to be publicly known. Alleviating market improved by compensation packages aiming at long-term incentives, and penalizing policies with destabilizing effects on financial markets. Third, on a macro level, increased transparency relating to effective risk measurement of rating performance stabilize. And it needs to stabilize for the evaluation of financial assets, and hence improve the solvency of financial intermediaries. And by fourth, financial intermediaries whose risk is opaque may be subjected to higher capital requirements. Asset securitization is one of the mechanisms of business financing that has acquired greater importance in recent times, since it allows companies interested in improving their levels of liquidity to obtain resources more quickly and at lower cost compared to other sources of traditional finances, such as a credit banking or the issuance of obligations.
Now we are going to see the conclusion of our presentation. Conclusions and recommendations. The first conclusion of our presentation is that private companies gather a group of assets together, issue them, and investors buys them. The issuer is called originator, and the group of assets is called security. Corporations often use the securitization process in order to get rid of illiquid assets in their balance sheet, so that they can receive liquid from these illiquid assets in return in order to finance their operations.
Now, I will give my conclusions, and the first is that the rate that the rating company gives to originators has to include the credit risk, the liquidity risk, swap counterparty risk, warranty risk, legal risk, sovereign risk, and the interest rate and currency risk and prepayment risk. With this, we have to take all the risks about the rating of the company to the originators that include all these risks that I had mentioned. And then my second conclusion is that the securitization is one of the best ways to protect the financial market. It goes developing to the hand of technologies, and actually what a business company or industry needs is to get innovated. Like was given on an example, it is the best way to revolutionize the financial market, giving it the level of security that is necessary.
I'm Luis Torres again. I will do the last two conclusions we have of this topic. And our securitization is one of the best ways to protect the financial market. It goes developing to the hand of technologies, and actually what a business company or industry needs is to get innovate. Like was given on example, it was the best way to revolutionize the financial market, giving in the level of security that is necessary. Also, the attraction of securitization is this of financing, or it gives companies that can afford to finance themselves based on their profitability. It does not mean that it's a strategy to be able to adapt for any item and is applied in similar way. Well, this requires a gigantic planning, execution, regulation, and subsequent evaluation to only be able to put this financing method into action.
Now we are going to see the recommendations of our presentation. Our first recommendation is that the securitization process can help the companies that are struggling or whose growth is constrained by giving them some financement in order for them to continue their activities. They also get rid of the liquid assets in their balance sheet, and those new incomes that were previously originated will help them to finance their current or new activity.
Okay, as a second recommendation, we put the investors have to analyze carefully which security they buy, since they incur a lot of risks that may not ensure the return of their money. The securitization process is a financial tool that has a lot of risks, and the return might not be what was expected. The investors may have to insure those assets in order to lower the risk of possible losses.
And the last recommendation, as history has shown, every process that involves incurring avoidable risk must be highly regulated, something that was not done when the 2008 crisis expanded through securitization. This process was a bridge that transferred the crisis from the United States to the world. The most serious thing that was that it is a great financing tool which was not known to regulate, and as a result of the fact it has been limited in such a way that it has lost its attractiveness as a strategy to choose, for which we consider that the formulation of the regulatory policies of this practice should be evaluated. Thank you.
Well, these are the references that we found during our research. And will be the end of our presentation. Thank teacher for watching this video.